Apple doesn't grow anymore, but it acts like a growth company. So, what is it really? Well, let's have a look at how growth stocks perform compared to value stocks. Now, the starting point here is the COVID low. We watch SPYG and SPYV as growth and value ETFs. Now, as you can see, the return is literally the same, 87 against 90% over the course of 3.5 years. Here are two clear periods when value underperformed, end of 2020 and end of 2021. But since then, value companies actually did better. Now have a look at this. Slightly positive for value and negative 14% for growth since November 2021. Now let's add Apple. The pattern repeats the growth companies until it completely took off in early 2023, gaining 29% year to date and 50% at its peak. Now the sentiment switched. Here are the January 2024, June 2024, and January 2025 options accumulations. Now, in the last 30 days, traders have switched from the strong buy sentiment to an incredible increase in bearish bets. And while short-term $170 seems like the first target, in the longer run, $140 seems like a more popular trade. So what is the reasoning behind it? Well, first of all, the company stopped growing. When we analyzed Tesla a couple of weeks ago, I pointed out how important the market is. So let's stick to the checklist and have a look at the Apple business environment. But before we proceed, have a look at our next topic to discuss. Are the news and headlines just an irritating source of noise or a really influential thing? We will conduct a statistical research of how the markets move and which types of events and news actually have power over stocks. So please subscribe and join us next week. Apple's revenue comes from two main sources: products like iPhone, iPad, and MacBook, and services like app purchases or music. Products revenue has been declining in the last 12 months, while the service revenue only went up by 8%. It witnessed decreasing gross margin. But how big is the market? Now, the smartphone market is around $520 billion and is expected to double in the next 10 years, which gives us a CAGR of 4.1%. Not exactly a growing story. Well, Apple's market share is currently around 27.6%. So that tells me the market penetration opportunity is really limited unless Apple tries to create cheap models for India and China. So the market share in the US and UK is well above 50%, so no growth comes from the home market. Now let's just say the product segment is not growing anytime soon. Apple needs to invent new products here, unlock new markets and niches like they did with the iPhone, but it doesn't seem like they're doing anything about it. Now, the services. Digital content is relatively a young market of $173 billion, growing at a pace of 6.3% CAGR. Now, Apple has strong and protected positions because of how the ecosystem of services is tied to the operating system, iOS. And the best paying users reside in the countries with the highest iPhone market share. So Apple makes around $85 billion with a market share of 50%. Not exactly like there's room to improve as well. The estimates of Wall Street show an expectation of circa 6% revenue growth in the next 2 years, which is in line with market growth. And that doesn't really look like a growth company. The rate is even lower than the average of S&P 500 expected 8%. So now we know Apple is not a growing company. Let's have a look at its peers. First, the financial strength and growth pace peers. Now, to make sure we pick only good companies, I used a screener to filter out companies with too much debt or liquidity issues. Please meet KLA, Amgen, and Gilead. Now, let's compare. Now, as you can see, Apple is one of the worst in valuation and are definitely the worst in dividend yield. The premium and PE ratio is more than 50%. Well, Apple's fair value sits at least 30% lower, and they would still have to raise dividends 5 to 6 times to be anywhere near as attractive as Gilead or Amgen. So it doesn't look like Apple is a great value stock right now. How about the stocks with similar PE, even the big ones? Here comes a warm welcome to ASML, Alphabet, and Thomson Reuters. Look at the growth numbers: 15.6%, 18.4%, 21.7%. These are the earnings per share growth expectations from Wall Street analysts. But wait, those companies still have incredible profitability, and some of them even pay dividends. So Apple is not exactly a growth stock either. Well, where is it compared to the broader market? Let's use the FinViz screener again. Now, I want to be fair to the magnificent company that Apple is, so we will only compare it to profitable companies with acceptable debt and current ratio above 1. Now, I also want them to be growing in EPS in the next 5 years. Now, having filtered out all the stocks with no data or any of the metrics that we use to build the Apple profile, we have 777 stocks left. Trust me, I didn't intentionally narrow it down to 3 sevens. That magic trick pulled itself. So anyway, the picture is quite clear. 40th percentile for sales growth in the last 5 years. 76th and 75th for the future growth means that Apple is growing faster than 75% of the peer companies. Now, price to free cash flow sits in the 36th percentile. Price to book value, horrendous first percentile, literally one of the 3 worst in the market. A price to sales, 9th percentile. PEG is a ratio to measure growth compared to PE valuation. Apple is in the 23% of the worst companies. Now, for next year, price to earnings is in the 13th percentile, and the current valuation of 28 price to earnings is in the 39th percentile. So, you can see the only virtue that this stock's valuation has is growth, but the growth rate is ridiculously small. So why don't we just create a new bucket for Apple and Amazon and call it Just Because? Visual Sectors is the perfect answer to the when question. We help retail investors understand key trends in the market, and our data sets put a calendar date on them. We source the most complicated data from Standard & Poor's, FactSet, and Options Pricing Reporting Authority to turn them into easy-to-read charts with up to 72% win rate based on 10-year back test.